Good afternoon, everyone. This is Chris Cahill at 12 Points Wealth Management. I'm going to be starting the February webinar, Life, Death, and Disability, in just a moment. There are a couple of more folks that are going to be joining us, so I'm just going to place you all on a brief hold for a moment, and we'll come right back and begin in just a moment. Thank you very much. All right, so we've got a quorum here. I figured that we might as well just start going in the interest of being respectful of one's time. It's noon, and thank you for joining us. Here again, we are for the February webinar, Life, Death, and Disability. Pardon me. So there you see me, Chris Cahill. I'm a partner and principal here at 12 Points Wealth Management. I've got over 20 years of experience in consulting with individuals, particularly lawyers and law firms, managing all facets of their financial planning, estate planning, and charitable planning needs. I'm pleased to be here today, and thank you for taking the time out of your schedules to join us. So, life insurance. Basics of life insurance. What is it? So it's a contract between you and an insurance company. They provide you with coverage, you provide them with a premium payment. Now we're going to get into the specifics of the types of insurance here. Term insurance, permanent insurance. The world breaks down very broadly in those characteristics. There's a whole bunch of different types of insurance that fall under the permanent insurance umbrella. But for purposes of this conversation, let's keep it simple right now and talk about the differences of term and perm. So term insurance is designed to provide for coverage for a certain period of time or to a certain age. This is the type of insurance that we utilize for many of our clients who are looking for basic coverage to protect the spouse, children, loved ones, survivor income needs, income replacement, things such as that, paying debts, mortgages, etc. Term insurance is the most cost-effective on a cost per thousand basis. We sell a lot of term insurance. I think it's a really good product for the majority of our clients. Now, there are certain circumstances where somebody wants to have a policy that will last forever. The difference in the hallmark of the term insurance is that it will typically only go for 10, 20, or 30 years. Some folks don't like the idea of paying a premium for 30 years and not ever getting a benefit from it. I would submit to you that you don't necessarily want to collect on your death benefit, but that's a different discussion. So for those folks that really feel like I want to make an investment and guarantee that the death benefit will be paid to my family, those folks are really looking for a permanent policy. One that has an investment component in conjunction with the insurance component. There's a whole host of different types of permanent insurance. I'll mention a couple of them here. Today's topic is really designed to introduce you to the world of life insurance and disability. We're not going to spend too much time getting into the intricacies of the permanent insurance world, but suffice to say that it really breaks down as follows. Whole life insurance, that's the granddaddy of life insurance contracts. You pay a premium, the policy generates a cash value, and it will provide a death benefit for however long the policy remains in force. Whole life insurance is a really great solution for those looking to have a policy in place forever. It can, in fact, does generate good cash values, which can be utilized for all manner of planning. They're often used to help support and supplement retirement benefits and retirement income streams for individuals. So we really like whole life from that perspective. It's certainly a thing to remember. Term insurance, very inexpensive on a cost per thousand basis. Permanent insurance, by definition, of the fact that it's going to be there later to pay a death benefit is going to be more expensive. The most expensive of the permanent insurance is traditionally this whole life insurance. We then get into the world of universal life insurance, which can break down further into subcategories of guaranteed universal life, where the death benefit is guaranteed. You know that you pay a premium, the death benefit is going to be there. There's no question about that. The cash values typically are not going to accumulate as great as one would in a whole life contract. Some people don't like that. They like the flexibility of the cash values. A current assumption universal life policy will have more in the way of cash values, but less in the way of guarantees on the death benefit side. So it's kind of a give and take. What is most important to you? I would submit to you that in many instances, having an insurance portfolio that comprises of a couple of different types of contracts might be appropriate, whether it's term insurance, some whole life, and maybe some guaranteed universal as well, or something like that. We then have variable universal life. Variable universal life invests those cash values in sub-accounts, meaning investment accounts, things like stocks and bonds and other sorts of investments. So again, you're trying to take market risk there and generate a greater cash value, which would then potentially increase the death benefit. Those things have a little bit more market volatility, as you can imagine, and that the sub-accounts are invested with the cash values. But they're appropriate for some folks. A compromise between the variable universal life and the guaranteed universal life would be a thing called an indexed universal life contract, or an IUL. The indexed universal life simply says you're going to get a percentage of the increase in some index. Typically, it's the S&P 500. So if the S&P goes up 10% in 2019 and you have a contract that says you're going to get an 80% participation rate, you'll get an 8% return. If the S&P goes down by 10% in 2019, you'll get 0. So you don't lose money. It gives you the opportunity to participate in the upside of a market without having negative returns like you could get in a variable contract. Some people really find that attractive and appealing. We sell all of these types of insurance, but for the variable universal life here at 12 points. And I think you can understand why the volatility therein is just a little bit too much for us. So moving forward, why would one buy insurance, right? Basic income replacement. That's the time when most people get involved with insurance is, I'm buying life insurance for my wife or for my children. We have debt repayment that we would like to cover, a mortgage. I would say to you that in many instances, student loans, if they've been refinanced, are also going to fall into that category. Federal student loans, they're not going to be a repayable debt at your passing, typically. So know that those, if you maintain the federal component, aren't going to be part of a debt that you'll need to repay. But if you have refinanced them, as many clients of ours do, you're now out of the federal loan repayment program and into private pay. Those would, in fact, be required to be paid off at your passing. So having income replacement, debt repayment, funding some specific event, having cash there for your grandkids to help pay their college expenses, whatever that may be, certainly burial expenses. And as we talked about a moment ago, generating cash value for retirement, asset diversification is really key as well. Many instances, that cash value can be viewed as a bond replacement or supplement. So those are really things that are appropriate and interesting to contemplate. So tax advantages of life insurance. The death benefit is paid income tax-free, capital gains tax-free, and estate tax-free, depending upon how it's held. So a death benefit from a life insurance policy is one of the best vehicles, best ways to inherit wealth. Obviously, nobody wants to inherit through a life insurance policy because by definition, a loved one has passed. But getting past that, if you had a choice of getting an asset that through various mechanisms, a death benefit is a good one. Certainly, there's cash value. We discussed that. The cash value in a life insurance policy grows tax deferred, which is a tremendous vehicle, right? So those of you that are saving, hopefully all of you, in a 401k or an IRA, the reason you're doing that is you're trying to capture the tax deferred growth of assets. If you've maxed out your 401k or your IRAs and you're looking to continue to grow assets tax deferred, a life insurance policy is not a bad place to look as an alternative. But again, I would caution you, I'd hope that you max out those other vehicles first. You can take withdrawals tax-free from the cash value in a permanent policy. So withdrawals up to basis are tax-free. So if you've invested $100,000 into a whole life policy, and by invested I mean paid premiums of $100,000 over the course of a period of time, and now there's $200,000 of cash value, say, that first $100,000 that you take out, you can take out tax-free. You could then take out more by utilizing a loan feature. The loans actually come out tax-free as well. So withdrawals up to basis are tax-free, and then loans thereafter can be tax-free. So insurance policies do provide some good retirement planning vehicle flexibility. You got to be careful with the loans, though. You really don't want to lapse a policy and have outstanding loans, because then you're going to have recognition of income taxation, and that's not a good thing for anyone. So what affects the costs in life insurance? Well, a number of things. Gender is one of the most important. Women typically have lower life insurance costs than men. Interestingly, we're going to see the difference that's flipped when we're talking about disability insurance and long-term care insurance. Health questions, in fact, affect your ratings. Obviously, if you are in excellent health, as these individuals on the screen appear to be, they're likely going to be a preferred underwriting classification, meaning that they're going to get the best cost and price. If you have a significant medical condition, that will obviously impact how the insurance companies view your mortality risks. The exams that are done will help determine what sort of classifications you have, and your lifestyle. If you're a smoker, if you consume a lot of alcohol, if you have a risky hobby like skydiving or things like that, that will impact it. Family history certainly does as well, as does marital status and where you live. So these are all of the things that really affect the costs of premiums. So it's always better to buy insurance when you're healthy. It's always better to buy insurance when you're young, because it will always get more expensive. So what's the right type of insurance for your need and life stage, right? Singles, there's many instances where they don't need life insurance at all, truly. We do have many clients that come to us that are single, without families, without any significant financial requirements or commitments, that still want to buy insurance, and what they're really looking to do is lock in insurability. Can totally get behind that. So what I mean by that very simply is, if you've got a concern about buying insurance in the future, you think, hey, what if I get sick? I can't get it. I expect I'm going to get married. I expect I'm going to have kids. I would submit to you that you should probably buy a policy and lock in that coverage. When you're young and healthy, buying a term policy that could convert to a permanent policy would be a really smart play, especially if you're, as I said, young and healthy. It would be very inexpensive. Young families, the needs are obvious, right? Providing death benefit for a surviving spouse, to provide for the care and education and lifestyle of children and family members is important and critical. That goes hand in hand with proper estate planning. Obviously, mature families, now you're looking at building a legacy with both mature families and empty nesters, retirees. Really, the question is, what are you looking to leave behind for your children and grandchildren and future grandchildren, as the case may be? Life insurance can be a really great tool to help effectuate all of those objectives. It's really important to review your policies, making sure that you have the right coverage in place and that it's doing what it's designed to do is important. Many people buy their insurance policy, buy their insurance and stick it in a drawer and forget about it. not something you want to do. I think it's appropriate and important to do an audit of an existing coverage, existing portfolio of insurance every several years. Take them out, look at them, see where you are. Are they providing the sort of coverage that you need? Have your needs and goals changed? Do you need different coverage? Do you even need this coverage? These are important questions. Policies that are permanent, that have cash values, should really be looked at from a perspective of having a full review as it relates to how the cash value is performing. Whole life policies are going to be more predictable as it relates to the cash values, but the VULs are going to be more susceptible, as I said, to market value fluctuations. Could have done really well in 2017 and gotten beaten up pretty badly last year. Does that impact your views as to the importance of the policy and what it's doing and how it's going to perform? These are all of the things that we here at 12 Points can and would love to help you figure out by helping you with an independent review. So what if you find that the policy is not performing as well as you'd like it to? This happens, unfortunately, more times than I'd like to admit as we look at policies for our clients. You can restructure it. You can change the way that the policy dividends are being credited. For a whole life policy, you could switch it to reduced paid up. There's any number of things. We could do partial withdrawals on a universal life policy. We could surrender paid up additions for a whole life policy, but it's important to capture and know that there's a problem as soon as possible with an insurance policy, not let it exacerbate and get out of control. We could pay down loan balances. We could add money. If a VUL has been underperforming, sadly, in many instances, you're going to need to pay more into that to get it to go where you want it to go. So adding more money to a policy is always an option. What if you have a policy that you no longer like? You had a VUL that's run its course. It's no longer appropriate from your risk tolerance perspective, but you still want a permanent policy. You could do a 1035 exchange, which would mean a tax-free exchange from a variable universal life policy into another permanent insurance policy. The cash value rolls over, tax-free, tax-deferred. There's no taxation on it. And you now have the potential benefit of the new chassis, if you will. So you could take that VUL and turn it into a guaranteed contract. You could take it into a whole life contract or into an IUL, whatever the case may be. Say something happens and you really no longer need this coverage. It pains me to see people surrender life insurance policies, but sometimes it's the right thing. And by surrendering it, you get the cash value, the net surrender value. So, that might be the right thing. It might also be the right thing to contemplate selling it. So there's a market called the senior settlement market. It's basically a secondary market for life insurance policies. So if you know anyone that's in the age of 60 years of age or older that have a policy that's in force, but for whatever reason they no longer need it, if they've had a change in health, so the ideal characteristics for these sorts of transactions are somebody that has a policy that was issued at good underwriting classification, somebody that maybe was preferred underwriting, had a change in health, no longer needs or wants or could afford the policy going forward, but to surrender it, they're going to get hypothetically $100,000 of net surrender value. We can take the policies out to the marketplace through a group that we work with. They can market the policies and sell them, in many instances getting more than that $100,000 of net surrender value. Obviously, the facts and circumstances of every situation will determine what the values would be, but just know that there is an option out there for that. Let's face it, it's a little bit ghoulish to sell a life insurance policy to somebody that you don't know on yourself. So some people really don't like that. I can totally understand that. We do have clients that have done very, very well by selling policies that they no longer need or want, though. So, recent tax law changes. 2017 Tax Act took the estate tax exemption up to $11 million plus. That's a lot. So a married family today can move from the federal estate perspective $22 million plus down without a federal estate tax. That's an amazing thing. What that means to me is that many people no longer need or want their life insurance policies because a lot of these policies were sold to replace estate taxes. If you have a policy that's no longer needed or wanted, that secondary market may be an option for you. Alternatively, you might just decide to fund a policy differently. These are the sorts of things that we're happy to help with. It's really important to pay attention to your insurance policies. We're happy to do these independent audits for you. We don't charge for it. We view it's an important component for our client relationships. So know that that's an option for you. We're going to transition now and talk about disability insurance. I would submit to you that most folks out there are very comfortable with their needs of having life insurance. You get married, you have kids, I'm going to have life insurance. It's amazing to me how few people actually have disability insurance. In fact, most Americans don't. Disability insurance will pay a disability benefit as a partial replacement of your income if you become injured or sick. It's one of the most overlooked pieces of coverage that I find, and again, most Americans don't have it. What are the major causes of disability? Strangely, it's illness, not accidents. So over 85% of disabling accidents or illnesses are not work-related. They're often things like cancer, stroke, or heart disease. Really, really important to pay attention to disability insurance. Most employers will have a basic group policy that will cover a minimum amount of coverage for you on a monthly basis. Those policies are great, and you're thankful to have them should you need them, certainly. But I would submit to you that in many instances, they're not going to provide enough coverage for you to cover your income in the event that you do become incapacitated and disabled. Duration of disability. On average, a disability may last a lot longer than you think. The average duration in the United States is currently 30 months. Nearly 1 in 5 Americans will become disabled for a year or more before they turn 65. That's an amazing statistic. An amazing statistic. 20% of the populace will be disabled for over a year before they're 65 years of age. Think about that. 3 out of 10 workers between 25 and 65 will experience an accident or illness that keeps them out of work for 3 months or longer. Having disability coverage is critical. This takes care of you, folks, by the way, right? Life insurance will provide for your heirs, your children, the folks that you love. Here, this is taking care of you. I would submit to you that this is something that you should pay attention to. Again, the statistics are a bit scary. You're 3 times more likely to need to become disabled than you are to die prematurely. You have a 1 in 3 chance of being disabled for 90 days or more before the age of 65. The average disability, again, is 30 months. And medical problems contribute to 62% of all personal bankruptcies in the United States. That's craziness. You can protect that with a properly focused and designed disability program. How do you do it? As I said, you can have some coverage through your employer. Typically covers a portion of your comp. It's not going to cover all of it. You can buy your own policy. I submit to you that that's one of the best things that you can take away from this presentation today is to contemplate buying yourself a disability policy. The employer that you work for could generate a executive benefit program and implement a more robust disability program for you. Happy to speak with any of them as well. So there are more options under the employer-paid plans. And then, of course, you have Social Security, but don't assume that that's going to be sufficient to provide for you and cover what you're likely going to want covered in the event that you become disabled. So what does one look for in a disability policy? You really need to look at the definitions. The definitions of disability are critical. I'm going to go over each of them in a moment. Income. How much are you trying to replace, right? You typically want to have coverage that's equal to 60% of your current pay before taxes. So what does that mean? If you make $100,000, you want a policy that's going to pay $60,000 a year or $5,000 a month, right? Many group policies will do that. The problem comes in if you make $200,000 a year and you have a group policy that pays $5,000. You'll have $60,000 of compensation, but you're not going to have that additional $60,000 that you would really need should you want to cover the full benefits. An important thing to recognize as it relates to this component here is also the taxation of disability. If it's a group policy and the employer pays for the coverage, that benefit, when paid to you, will be taxable. So under that scenario I just outlined, the $5,000 a month of coverage, if that's in fact paid by your employer and not by you, you don't even get the $5,000 a month. You're going to get that as taxable income, and the net will be less. Really important to pay attention to that. An individual policy that you pay for is going to be tax-free. A group policy that is payroll deducted that you pay for will also be tax-free. You want to work with a company that's got a strong reputation in the industry. Companies like Principal, Standard, etc., excellent names in the industry. You want to make sure that you're covering the skills that your occupation requires. If you're a surgeon, if you're an attorney, you want a policy that's going to make sure that you're not going to be forced into doing some sort of work that's not utilizing those skills. And high wage earners are different. They come with different issues. So we really need to look at high limit deductible plans for these folks, athletes, entertainers, etc. So the definitions, I'm going to just kind of blast through these pretty quickly. Probably if you've ever spoken to anybody about disability insurance, you've probably heard about ONOC. Own occupation, this is the strongest definition. What this really means is if you're unable to perform substantial and material duties of your occupation, this will allow you to work in another occupation but still collect your benefits. So if, again, you were that lawyer or doctor, you could become a Starbucks barista if that was your desire after becoming disabled, and this policy would still pay. Popular with professionals, as I said, lawyers, doctors, dentists, and others with specific specialties. ONOC is also the most expensive definition to be buying. So many of our clients choose to go with the transitional own occupation definition. Here, this is similar to the ONOC definition, only it differs if you decide to work in a different occupation. So then the carrier will compare the new income in combination with the benefit amount to see and compare it to your pre-disability income. If the combined income is less than your pre-disability income, you get to keep the full benefit. If the income is higher, the combined income is higher, the carrier will reduce the benefit dollar for dollar. But this is going to indemnify you for 100% of your pre-disability earnings. That's typically sufficient for most folks. As we continue on here, own occupation and not working or not engaged. This is when you're unable to perform substantial material duties of your occupation and you're not working. The not working is the real differentiation here. This provides you with the protection as long as you don't choose to go back and work in a different occupation. Often used in white collar or corporate executive marketplaces or for small business owners. Interesting to note and important to note that the carrier can't force you into a different occupation here. So we're kind of walking down the cost perspective here. The cheapest definition is any occupation. This is also the weakest definition. Here, the inability to perform the substantial and material duties of your occupation, and you're not working in any occupation. With some occupations or health conditions, this may be the best definition that you've got. Blue collar or high risk occupations typically are only going to qualify for this sort of definition, but it is important to pay attention to it. Moving forward here, income replacement. How much do you really have, right? Again, if your employer pays for the coverage, then the benefit that you receive is going to be income taxable. Many people don't know that. Really important to understand that. If you pay for your policy through work, or if you own your individual policy, that benefit is going to be tax-free. That's a game changer. So let's look at an example. An associate at a large law firm in New York earns $350,000 a year. I know that seems like a lot of money to most of us up around here, but trust me, in New York, it's not as much as you think it is. The net income is around $210,000. The firm pays for his coverage of $15,000 a month, or $180,000 a year. Since the firm pays for it, this benefit is taxable. What does that mean? That means that he's getting $108,000 annually after tax. So his $350,000 of income squishes down to $108,000 annually, or $9,000 a month. This is 31% of his gross comp and 52% of his net comp. Current shortfalls on a monthly basis for him would be $8,500 or $102,000 a year. That's material, that's significant, and that's a big, big change in lifestyle in a city like New York. It's not being able to pay your rent sort of changes, to be honest. So this is something that is really important to understand and pay attention to. Then the question is, how do I know how much I need to have? So I would submit to you that you could utilize this screen here. Those of you on the webinar today might want to just take a quick screenshot, pull out your phone, take a picture of this. I'm happy to send it to you should you like. Simply send me an email. Really just comparing your income from all sources with your monthly expenses and looking at what that shortfall would be, and then trying to replace that. So, you know, this is a really important component. Knowing how much you need, how to own the policy, and what policies to buy, and what the definitions are can help you with all of that. Many people ask this question: doesn't workers' comp and Social Security cover disability, though, Chris? The short answer is no. Workers' comp covers time away from work if the disabling illness or injury was work-related only. If it's not work-related, you're not going to get workers' comp. It's that simple. From 2006 to 2015, only 34% of Social Security disability claimants had their applications approved. 34% of SSDI claimants got their applications approved. That's scary. You can't rely upon it, and even if you did get it, the benefits are small. So what can be done? Contemplate buying an individual policy for yourself, certainly a great solution, or have your company institute an executive disability program. We're happy to help with either of these scenarios for you. Executive disability coverage, what would that look like? It's a great layer of additional coverage to an existing group DI policy. These policies are not just additions, though. They're actual individual disability contracts that you as the executive would be the beneficiary of, that would give you the following benefits. Individual disability policies can protect more types of compensation, bonus, commission income. You get improved definitions of disability and portability. That's huge. What that means is you leave the company, you take this policy with you. And you go to start at a new